Stocks have picked up again in November after a 3-month slump, with the S&P 500 up 5% and the Nasdaq up 7%. Investors already looking ahead to the Santa Claus rally. Let's bring in our very own Jared Blikre, who is here with what to expect. Until then, Jared.
Yes, it's never too early to talk about Santa Claus. We got pumpkin spice latte in the rear view mirror for 2 months. I'm looking at the VIX right now. A couple of seasonality notes. Seasonality is what stocks or any instrument tends to do over a protracted period of time. The most common one is calendar seasonality, and we've seen that really work in favor of stocks this year, the third year of the presidential cycle. Here's what we're looking at in the volatility index. Now, this runs inverse to stock prices. So when you see a big spike like we had in March of this year, well, that tends to be when stocks are going down. And indeed, we had that mini bank crisis. Now, stocks have been kind of precarious at times this year, but we had just coming off a magnificent run up here. Part of, helped in part by the Magnificent Seven, and also helped by a drop in volatility. This is implied volatility, which was dropping for 8 days straight, and now it's ticked up a little bit. But suffice to say, it is moving in the right direction. Simultaneously, we have net bearish bets among leveraged funds. Those are hedge funds. You can see those are still short. If it's positive, that's an expectation that prices are going to go up. But this tends to be a contrary indicator. So you actually want to see this at extremes, and that's probably going to give you more of a turnaround indication. Right now, in the middle of this range here for 2023 and 2022, it is saying that there is probably a bullish tilt, a bullish bias, just given the positioning that we have of hedge funds, which is a bit bearish right now. Also taking a look at short interest in the Magnificent Seven. This goes all the way back to 1995. So some of those weren't even in existence back then. But nevertheless, you can see not too much short interest right here. But I would say that nevertheless, despite all this, we've seen a huge contribution from the Magnificent Seven stocks this year. And finally, want to take a look at call options volume. This has been a factor in years past, especially 2 years ago in 2021. We saw huge run-ups in stock prices concomitant with this huge run-up in call option volume explosion. This little peak right here, this was taking place with a rally in stocks a little bit earlier. Anytime you see one of these, it tends to create a positive feedback loop where options dealers, what they need to do to hedge their bets against the people buying and selling options, they tend to drive prices up in a feedback loop. So what I'm showing here is that we've finally seen kind of a resurgence of this. Haven't seen too many of those since we got that big bearish stock market last year, which has morphed into a bull market this year. Haven't really heard about call option volume too much. Now, a little bit of cold water, have to go with one potential headwind here. That is the 10-year T-note yield. Now, this is up quite a bit. You can see from where it was down underneath 3.5% all the way in March, and that was during the mini bank crisis that I've talked about here, all the way up to 5%. And the latest run-up in prices that we saw in the S&P 500, that was on a drop from 5% to 4.5%. Suffice to say, if we see the 10-year surge above 5%, that's probably going to put a damper on any expectations for stockholders going into the end of the year. But not to get too far ahead of ourselves, hasn't happened yet. And we do see the 10-year hovering around 4.66% in safe territory for now, guys.
Indeed, for now being the key phrase. Always great to have your insights. Yahoo Finance reporter Jared Blikre, thanks so much.